Good afternoon, everyone, and welcome to Red Cloud's webinar featuring Spanish Mountain Gold, SPA, on the Venture Exchange. We're really pleased today to have with us the CEO of Spanish Mountain, Peter Ma. He's going to provide us with an update on their recently released PEA on the company's 4.2 million ounce Spanish Mountain Gold project in central BC. The company is intending to advance this aggressively towards a production decision, unlock the value that they can find from this project. It's a long life asset. It's got a lot of upside. My name is Ron Stewart. I'm a research analyst here at Red Cloud, and I'll be your host this afternoon. If you wish to ask a question, simply type it into the chat box on the screen, and we'll get to as many of them as we can towards the end of the presentation. In today's webinar, you're going to hear some forward-looking statements. We advise you to look at the company's cautionary statement on page 2 of its investor presentation. You can find that on their website at www.spanishmountaingold.com. I'd like to point out that the presentation today is really for information purposes only and not a solicitation or a recommendation from Red Cloud to either buy or sell the securities. Participants really should rely on their own research and seek out professional guidance before making any investment decisions in respect of the information that you hear about. Finally, our research on Spanish Mountain can be found at our website at www.redcloudsecurities.com. We ask that you review our research and disclosure documents at the ends of our reports. With that, I'm going to pass it over to Peter to let us hear about Spanish Mountain.
Thank you, Ron, and good day, everyone. Thank you for joining us, and welcome to my update on Spanish Mountain Gold. It's a pleasure to present to you today. It's a very exciting time for our company with the culmination of 2 years of work and really where the gold industry is at, and a very exciting time for shareholders, new and old alike. We recently released the results of a preliminary economic analysis, which included an updated mineral resource estimate, and that outlined our new vision to advance the project to a build decision in 2027. We are an emerging gold developer with a project in South Central British Columbia, Canada. That is just to give you an idea of the value proposition here. Our at spot gold price of $3,300, our project has an after-tax NPV, 5% NPV of 2.3 billion Canadian, a 2-year payback, and an IRR of 32%. So as many of you are aware, it's a really compelling time for the gold industry and advanced projects, particularly like ours. The project's been significantly de-risked, and we've identified plenty of upside. The company's strategy is to advance the project expeditiously and sustainably towards production, catching this bullish gold cycle. Next slide, please. As Ron noted, this presentation contains forward-looking statements, and I encourage you to read this slide. Next slide. Our project's located in a Tier 1 jurisdiction, approximately 70 kilometers east of Williams Lake, where the little red loop is there on the inset. The updated mineral resource contains over 4 million ounces of gold with plenty of drill targets to expand. I'll get into a little bit of that at the end of the presentation. We have very prospective host rocks over a 10-kilometer strike length, and it's on a 100% owned 10,000 hectare property. So lots of, I call it a double Lassonde curve, but more opportunity to add and discover mineralization and bring it into, the project as we advance. And the idea is to build the mine, generate cash flow, and use that cash flow to unlock the full potential here over 10 kilometers. We have year-round access on with paved road to within 6 kilometers of the site, and the rest of the site is accessed through existing gravel roads. Excellent nearby infrastructure, workforce, supply chains, several operating mines in the region, all are very supportive of why we think this is a Tier 1 jurisdiction. The company has advanced to Stage 2 BC Hydro System Impact Study for a power connection point, which is at McLeish Lake, just north of Williams Lake, at which point we would connect about a 75-kilometer power line that's proposed in the PA, and that would supply 60 megawatts of power at 230 kV. So really an excellent long lead item that we've been advancing in parallel with all our work so that we can, as I mentioned, try and capture this gold cycle. There have been really good long-standing relationships with the communities and First Nations, including strong support for the project. Next slide, please. There are four main pillars as to why invest. First, the project is highly levered to gold price. So at the $2,450 gold price, our after-tax NPV is $1 billion. At 33, it more than doubles to 2.3. So you can kind of see the leverage there. And the urgency to advance this project to a build decision. The company anticipates accelerating towards production during this gold cycle and coming to that build decision in 2027. There's great upside potential in the project. Not only have we hit the highest grade we've ever hit in the project in our 2025 program, we've extended mineralizations and we've identified ore sorting similar to a Cisco development north of us. We have very similar characteristics, and so some of our next steps will be looking at ore sorting test work, following up on the test work we did, and can we uplift our mill feed grades and therefore uplift our whole ounces produced profile and lower our costs even more and improve on the value and the higher cash flow that you see in the first 5 years. And then the fourth pillar, one of the big reasons that's very, I think sets us apart from maybe some of the other projects is that access of infrastructure is clean hydroelectric power and low cost power. So we looked at in the PA to optimize the use of that power as much as possible. We electrified some of the mining fleet, and we look forward to continuing looking at those options as we go forward in the next stages of development. In the last 2 years, that culmination of hard work and innovation, we've resulted in a de-risk project. We've envisioned state-of-the-art dry stack tailing storage and water management. We've increased mine life to 24 and a half years, an average of over 200,000 ounces of gold production at 300 million free cash flow during the first 5 years of production. It's pretty compelling business case. Next slide, please. Capital markets summary. 35% of our company is owned by key shareholders. Lem Janes plus management have 18%. Eric Sprott 11%. Ian Watson, our former chair, 6%. Market cap has been ranging between 80 and 90 million recently. So some nice share price movement you can see there. Performed well in 2025, virtually basically doubling since January from around a low, I think, of 9 cents to a week or two ago. We hit a 52-week high at 20.5 cents a share. Yes, there's still room. We get that question, did we miss it? I think like many explorers, and you'll see on a subsequent slide here, part of the value proposition is that explorers are highly undervalued and poised for a re-rate in this market. We have just over 55 million warrants outstanding, exercise price ranging from 13.5 cents to 25 cents. If all of the warrants exercise, that would bring 10.5 million Canadian into treasury, which would finance the pre-fees and get a good way through the feasibility. Can't resist the plug for all you warrant holders out there. Consider exercising. Next slide, please. We have a new board management team. We began that transition in 2022. I was a part of that transition. We have decades of experience between us and the skills in project management, construction operations to take this project to build decision and ultimately through to production. Obviously, in the next stages, we'll staff up more and again, build out our team to execute. But for now, we've got a pretty good, solid team. Next slide, please. So this is the slide I was talking about, breakout here, time approaching. So at the top on this is what I call the developer trend, and two premium emerged. Really, Artemis is now a producer. But and then at the bottom is the Explorer trend. And I was trying to look at 2 years ago, kind of like what was driving this change in terms of share performance. When were companies getting recognized? In the bottom is Spanish Mountain and a few other Explorers / emerging developers were all budding. And at the time, we thought it was around some very key moments and key moments that were tied to studies that were released that we saw were executable, permittable, financeable, and kind of the rest is history on those projects. And they're really great success stories we're all aspiring to reach to. Here on the bottom right-hand corner, the Explorer trend, you see really some interesting breakout. I say that it's approaching, but I think the breakouts occurred and is starting already for several of us. You can see Troilus, Probe, First Mining, Spanish Mountain, all kind of going up since March. And as investors are seeking the next quality assets of Artemis and Skeena, who are they and when do we get in? And I think we saw that starting January in our share price performance and who we've been engaged in marketing. We've seen a lot of generalists coming into the market. Of course, the global trade and geopolitical uncertainty has certainly fueled that desire in market. So it's a great time for us, gold developers, to be advancing projects. Next slide, please. So here, this slide here, just changing a little bit into the PEA and the meat of the results before I get into some of those details. What this slide shows here is a comparison of the 2021 pre-feasibility to the 2025 PEA. And you can see there's significant improvements. So mine life's gone up 75%, throughput 30%, life of mine mill feed, 139%, contained gold 45%. We've chopped the strip ratio in half. In the first 5 years, we've increased production 15% to that average of just over 200,000 produced. And the whole life of mine production, it was 2.1 in the pre-fees, and the PA contemplates converting 3 million ounces to produce. So that's sort of like 3/4 of the resource, which would be what you would expect. So that was a 43% hike. You can see on the right inset there the production profiles and grades, and you see that low grade dip there in the green curve. That's where we want to tackle. This is where, even though we have very good financial metrics and robust, there's still opportunity here. And so when I see that dip, this was part of the reason 2 years ago we started communicating about drilling extensions and looking for high grade. High grade for us is 0.6 to 0.7. I know that's kind of weird to be saying, but in today's gold price environment, that is high grade. And that dip is an opportunity. It's a risk and an opportunity. And so we've been fortunate to be adding some potential targets high grade. I'll come to that at the end. But the other component of this is, can ore sorting be implemented here to sort of double up the grade, as you've seen with the Cisco development in their press release recently? Our characteristics of our resource is very similar to a Cisco. We float it's a pyrite concentrate. So we think there's opportunity to involve technology and innovation similar to Cisco development to uplift our feed grades. And what would that do to the business case? We argue it'd be a pretty compelling uplift for both grade and ounce produced profile. Next slide, please. Lots of numbers and more included in the July 3rd press release. I won't go into the nitty gritty. Happy to answer questions at the end of the call. But I'd just like to draw your attention to some other key metrics I haven't mentioned. I did mention the free cash flow at 300 million average over the first 5 years at 2450 gold. At 3300 gold, that jumps to 450 million per year at 3,300 spot for the first 5 years. So again, really compelling time to move forward. What would ore sorting do to that? What would high grade discovery do to that? Pretty exciting. Low all-in sustaining costs. that I haven't touched on, obviously driving that robust cash flow. For the life of mine, we're just sitting over $1,330 an ounce, which is pretty decent considering we've got dry stack tails and we've invested in state-of-the-art tailings water management. But for the first 5 years, that all-in sustain, you can see in the press release, drops to an average of $1,024 an ounce. So really, really good numbers. And again, some upside on this deposit through further exploration and ore sorting. And then the life of mine. Having a long life of mine, it's good, gives you a long runway. You might argue that it's not optimized. We did look at expanding through traditional expansion approaches of more and bigger equipment. That actually eroded value. It lends itself towards bolting on or sorting. So that's why we've come out with this base case 26,000 ton a day operation with a good opportunity to expand and target for the next stages in the pre-FS and or FS to bring gold forward using technology. Next slide, please. Bit on the updated MRE. We took a haircut here. It was 4.7 million ounces. It dropped to 4.165 million ounces measured and indicated. That this was a good thing for us. I know it might not sound like a good thing, but we took a very conservative, more constrained approach to our mineral resource and estimates, and didn't allow as much freedom for the actual grades to extend beyond holes, and so this in coupled with not just the geologic and mineralized envelopes, but geochemistry. We have a really high degree of confidence in this, and we took those learnings beyond the resource into our drilling. As mentioned previously, in the previous slides, we've got over 230,000 meters of drilling. So this is in an early stage drilling project. The 2024 drill results were included in this update, some of 2025 at Phoenix, but not all of 2025 drilling because of timing. So there's still some work to do on a future update, which we hope would drive more upside into the project. In the main deposit used in the PEA for the financial model, this business case you've heard me talk about, 98% of that resource is measured indicated. So it's not a PA with a whole bunch of inferred. This is some high confidence geological resource classifications we've got in there. Give us a strong basis for a PA and confidence to move this forward, this project forward to the next stages of development and on to a construction decision, ultimately production. Phoenix, I mentioned we had an inaugural resource. So this Phoenix was discovered in 2011. We put 14 holes into it in this 2025 program and released an inferred resource of 350,000 ounces, not included in the PA financial model. So this is right proximal within about 1.34 kilometers of the existing pit. It's very close to the proposed mill in the PA. So we really like this target, and it, in addition to its prospectivity to include in future assessments of whether it's mineable and millable, is that if it is, it's a really suitable locations for tailings placement. And if you couple on ore sorting onto that, we could uplift the grade, maybe mine Phoenix first and create a nice depression for staging our tailings, our dry stack tailings placement in there rather than in and around it. So has a lot of great optionality and flexibility for the project. Next slide, please. Catalysts, are you on the catalyst? Yes, great. Yeah, okay, so we completed our 2025 catalyst plan on schedule and time in half one here. So that included the drill program, the MRE I mentioned about, the PA. So that's all out in that July 3rd press release if you want to peruse that. And then on the back of that, we're contemplating whether to advance to pre-feas or feasibility and making that decision in early part of H2 of this year. Over the next couple months, as I mentioned, we're going to be following up on these ore sorting tests and hopefully look at uplifting mill head grades and gold production as an expansion alternative. During the past 2 years, Spanish Mountain Gold has been doing some evaluation and amenability testing on ore sorting. These are previously announced in press releases and our MD&As. They were positive findings. It was a lot more work and variability testing than we could have afforded and had time for in the PA. So that's why it's a bolt-on target case option for the next stages that we're going to front end load here in the summer. And as mentioned, Cisco Development has released and announced their results of ore sorting that uplift their mill feed grades, and their Cariboo project has some similar characteristics to our project. So exciting options for Spanish Mountain Gold. Next slide. Just switching gears for a moment here. Our 2025 drill program, as I mentioned earlier, we hit 2 significant near-surface upside targets for the project, which were not included in the financial model of PA. First is the high-grade intercepts in the K zone. They're near surface within 150 meters surface, and they were identified in 2025 in a new mafic intrusive host rock. This mafic intrusive host rock also is the same host rock where the second main upside near surface target was identified, and that's Phoenix. So this gold bearing system, we have the sediment vein hosted system in the main deposit, and then next to this to the southwest is an entirely different intrusive system that might be sutured up alongside. You see the high grade here in the Hall of Fame. Some of the geologists and our structural geologists from SRK, when we showed them, next slide, please. When we showed them this hole and this basically this highest grade hit, right away you thought, okay, this is a shear zone. We don't know, but what's exciting is that we sort of have these two or more systems, gold systems, right up beside and interacting with each other that really are exciting for growth. And in terms of growth, so this slide is the K zone. We drilled this in 2025, got up there. It was a pretty steep path, and we intercepted the highest grade hit ever in the history of this project of 719 grams per ton over 0.75 meters. That hit was in hole 86 there, shown on the left of the long section. That was contained within 139 meters of 4.18, which is 5 to 6 times the average head grade of the first 5 years of production. So remember those financial metrics I talked about in the first 5 years and how robust and 300 million free cash flow. What would it do if we could find some continuity to the K zone here? And this is all within 150 meters of surface. It was in the pre-feasibility waste strip, and it's in this different rock units located proximal to the south fault. So it's really exciting. We've got more work to do, but that's some really exciting news for us and opened a lot of doors and minds. As you can see, there's not a lot of drilling to the left of that hole. The other hole, 1285, was drilled in the gap. The mauve colored modeling behind it, that's the K zone, a leapfrog kind of model of the K zone. We saw from our oriented drill core that the historical drilling was missing what we thought were the structural controls. We popped the hole in there, and lo and behold, we hit 39 meters of 0.99 grams per ton. So, 1.5 times the first 5 years head grade. So again, ultra high grade, really, in a sense, when you think about it in the context of the PA cash flow, and just sitting there. And so this is the value of the reinterpretation of the ore body. We relogged 175,000 meters of core, the oriented core, the keeping an open mind to the different structural controls and the host rocks, and seeing right within, needles in the haystack, if you will, right, of high grade right within the deposit. So that we learned a lot here, and we think this K zone might extend 2 kilometers along that south fault, and then actually if you go to the next slide, Phoenix. So this Phoenix deposit, you can see on the inset, this is a long section on the left inset there, you can see the south fault labeled there. So we actually think Phoenix connects somehow into the south fault and this conformable, I call it, sediment vein hosted main deposit structure. So really exciting. Phoenix was, as I mentioned, discovered in 2011. We unearthed literally the data, and Phoenix is underneath cover, so you don't see it in the gold soil anomalies like the other parts of the mains deposit. But we reinterpreted, put 14 holes in it, and as I mentioned, those 14 holes, we've got an inaugural inferred resource of 350,000 ounces. That was added all in at $5.11 an ounce. So that's pretty efficient, low cost drilling. Speaks to the quality of the asset, how quickly we can add opportunity and resource in. If you've got all-in sustaining cost of $1,000 and you got margin of $2,000 after that, you can do the math. I mean, it's pretty compelling. And if you layer on ore sorting and you can uplift the grade, this suddenly becomes a much more attractive target than may have appeared to, back in 2011. We hit some really high grade structures in there, both vertical trending northeast and flat. So oriented core is really helping us understand. It looks like this structure is controlled by a north-south trending fault, which is in the main zone. We have fault 1 and 2; those are north-south trending faults. So we're seeing some sort of repeat similarities to the main deposit happening over here. It's pretty early days. We only drilled to just really close to surface here, within 300 meters. So we intercepted that mineralization between 50 meters depth and 300. Many of those holes, as you can see, ended in mineralization. So we got to come back in here, do more drilling, do infill drilling, drill deeper, and really see what we've got here. But we're excited about this target, proximal to the pit and the new proposed mill, and as I mentioned earlier, to be a pretty good a location for future tailings storage. And this next slide, finally, in summary, we have a new vision, new strategy, new plan, and we're fast tracking towards a build decision in 2027. At this stage, we see no reason not to advance directly to feasibility, although we and the company and the management and the board are following a duly diligent process to review the results of the PEA and then what the next steps look like. But pretty bullish on going right to an FS, and we'll make that decision in the second half of this year early. So thank you for your time. Leave lots of time and room for questions. I'll turn it back over to Ron.
We've had a few questions come in while you were talking, Peter, and I do apologize for the delay. But the first one, I don't know whether you're going to be able to answer it, but has the board considered a reverse split on your stock, like consolidation? And do you have any sense as to what you'd plan to do for financing the build?
Yeah, no, great question. I see it here in the chat. Jim Pennell, thanks for the question. Yeah, obviously it's something we've talked about. No, we're not looking for a reverse split. We've actually had, since 2023, we've raised 3 tranches of financing, total of $18 million. So 6, 4, and 18. And in each one of those times, 8.3. Ooh, my math was a bit, that would have thrown you for a loop there. So yeah, 8.3 in the third tranche. Each time there was a lot of interest to take us all the way to feasibility. So there's strong demand for financing here. What we wanted to do is, I'm very measured about it, making sure that we have, scope, schedule, budget, and as I mentioned, those attainable, deliverable permittable, executable. We spent a lot of time on that over the last 2 years. So really want to get together what that scope and schedule budget looked like, and then move forward financing. I will say it's a very bullish time. We get approached for financing all the time, including traditional and critical flow. So I think the market's really good for that. But I don't think we need to do a reverse split to get there for now.
Okay, so I'm just going to take these questions in order. Adrian Cantwell asks, how long will the environmental impact take, and how do you have an estimate of how much it's going to cost?
No estimate yet. Time would be typically the times in BC. So the BC provincial system is harmonized with the federal. And so once you pass through the BC, the federal process just kind of falls in line. It's really, truly a harmonized process. So the EA process is typically 12 months and then 24 months for the permitting to construct after. You've seen Artemis and Osisko Development actually hit those timelines pretty well. So I argue BC is a really great jurisdiction to do business in. We were in a EA process and we put it on hold to rework this project. And so what we tried to do was preserve some of the footprint that was in the original project description, so we could hopefully shave some time off of that process. But those are the normal timelines. I think we can hit them, hence the sort of 3 years to build decision is all kind of ties up with that. And power would line up around the 3 years. What I didn't talk too much about is the potential for a saleable concentrate. We did do some test work over the last 2 years. There's an amenability for that, and as you probably know, Osisko Development is selling a concentrate. If you sell a concentrate, you're not permitting cyanide. So one of the attractive things for us to catch this bullish cycle is to do that variability testing around saleable concentrate. Could we chop that down and avoid initially at any, avoid cyanidation at site, sell the concentrate, bring in offtake financing, build the, you know where I'm going with that. So, I think given that similar flotation metallurgy to Osisko Development, there's a prospectivity we could do better there.
Okay. Our listener, Don, would like to know, you've done a great job updating your mineral resources, and he congratulates you. When do you think that you'd have a mineral reserve update? And I could answer that, but I'll let you.
Yeah. PA, obviously, we can't declare reserve, so that's why you're hearing us talk about mill feed and all that. That's the 43-101 rules. So a pre-FS or FS would be reserve. I mean, if we went through a pre-fees, and these are just high-level numbers, it'd probably take a year. If we went right to an FS, it's 2 years. If we went right into an FS, we would front-end load it with some steps of the pre-fees that we needed. We actually loaded in some of the pre-fee steps in the PEA. So we have like first principles mining cost estimates, some pretty detailed stuff. So this is how we try to position the project to leverage where we were and utilize the information we had and jump. But those are typical timings.
And Peter, one thing I'm curious about is I understand there's some silver in the system. Do you have recovery of silver, and does that provide you with a financing opportunity?
Yeah, it's an opportunity for sure for financing. It's an opportunity to get better. I think the pre-fees had it around 40% recovery, and I think we boosted it to 50 with a little work. But I think there's an even bigger opportunity here that might not have seen a lot of focus earlier. And we've seen through our reinterpretation and analysis and sampling of the ore body, we found, and we sample it right down to like the veins. So not these big 2.5 meter samples or 2 meter like a typical pit. We were trying to understand the controls and the indicator minerals. So just bear with me for a second. So we found some of the highest grades that I've been speaking about are associated with galena, and in the galena is the silver. And so we've been doing some structural work looking like maybe we're looking at the wrong thing. Maybe we need to be finding where the high grade gold is. We need to be thinking about the glean and the silver. So we're actually analyzing that. And could there be more silver? You talk to our structural geologists, they've seen some really strong structural silver structures. And so it's early days there. But yeah, I think we can improve on both. We're looking at it. 50% recovery silver is terrible.
Right.
But yeah, it's a good point.
But perhaps that speaks to a considerable opportunity to unlock a little bit more value, even if it is byproduct credit or as a financing alternative.
Yeah, yes. Silver stream. We have no. I don't believe in streaming the main metal.
No,
I think that's value destruction, in my opinion. And but certainly on a secondary byproduct like that, it could be good. But again, before you go down that path, we should answer that question: Is there 100-to-1 silver ratio somewhere lurking here that we've missed because we've been so focused on gold and argillites? Right. So yeah, I think all that optionality is open strategically, and certainly an area we have been looking at. We will continue.
The other question that comes to my mind is the advantage of dry stack tailings and its impact on lower sustaining capital. You obviously don't have tailings dam lifts and whatnot, which is a major part of the sustaining capital in any, large open pit mine. Can you talk to that a little bit?
Yeah, I mean, that's a good point, Ron. Our sustaining capital, I think we held the line fairly close. I think it was around 400 million. I can't recall exactly. But it was very similar to the pre-fees, even though we're a bigger operation, significantly more tons of mill feed going into the PEA. But it needs a higher capital outlay upfront, processing plant. What's really unique about this deposit is that like 20% of the gold's in gravity recovery. The other 80 is flotation. And when we looked at flotation, it was insensitive to grind size. So it had a P80 180 in the pre-fees. The PA has a P80 350. So we basically doubled the grind size. Not quite. But we did test work even beyond that. So now you got a coarser, think of finer powder and then think of coarser rock chips. That's what we got with the two differences. And so the coarser rock chips free drain. So 50% of the tails in the PA, you just run it over a screen, free drains, and you can place it like dry stack material. The other 50, you got to put through filter presses. And then, so the way our BGC envisions our tailings placement in these landforms is combining the two products, which the chips are great for drainage, and then you compact the dry stack in between. So these landforms can go virtually anywhere. They're stable, self-supporting, if you will, structures, not like a slurry tails where you got these big in the valley, big saddles. So what that means is not only is it more sustainable, better state of the art, we found a way to do it financially, growth. That the thing with a deposit like this is you don't want to put infrastructure over another $1 billion of value of potential endowment underneath. And so with these landforms, you can move them around and like, in fact, in the PA, we made a provision. It's probably not big enough for Phoenix, but it was just at the time, it was what the target was. But we can stage and move those landforms around that, mine out Phoenix, and then fill Phoenix with the landform. So it gives you great flexibility, better for the environment. And I argue, just like safety, what's better and more sustainable is more profitable if we can unlock the deposit around it and not sterilize it and have a double up in our mine plan and expansion. Wouldn't sustainability pay then? Wouldn't that investment pay? So this is sort of the secret sauce for this project of what I call following the double Lassonde curve. We have the building value to production on the main deposit, and then we have the rest of the 10-kilometer discovery barely touched. And we now have a tailings water management solution that's flexible to allow that to happen. So very excited about that.
So the other thing that springs to mind when you talk about something like that is the lower energy cost to grind in your mill. It's a considerable cost savings.
Absolutely. We released those numbers quite a while ago. We did a sensitivity analysis and study with BC Hydro. It was actually sponsored by BC Hydro and Andritz. We looked at everything under the sun. We adopted HPGR, which has a much lower power cost too. So the two together are very power efficient. We don't need the 60 megawatts fully for the PEA proposed mill. There's extra power capacity in there to accommodate potential expansion and or electrification of the haulage fleet if that technology comes through.
Okay, and the last question I'll ask it is, you report US dollar gold price, but do all of your capital and costing in Canadian dollars. Can you explain why?
Yeah, because we're building in Canada. We've mixed. I mean, other companies are doing it. You look at a Cisco, they've done it. We tend to show that. We tend to show all-in sustaining in US dollars. I know that's confusing, but
kind of a standard for Canadian issuers.
It is.
Canadian mines.
I worked for McEwen Mining and Rob, and we were on the NYSE, and we put everything in US dollars. I do prefer that, but we're on the Canadian exchange, and it gets hard to understand some of the other factors if we just report everything in Canadian. Perhaps we should do both. I've done that before, but it gets messy.
Anyway, listen, Peter, I really appreciate your time this afternoon to provide everybody with an update. This has been a real pleasure to host you. So thank you very much. I think we'll sign off on that.
Right on. Thank you, Ron and Red Cloud and all the organizers and everybody who's attended. Look forward to many more meetings and bringing this thing into production.